we have a gigantic bubble. I mean, we have 200. The Buffett indicator, which I think some people now thinks is irrelevant, but I don't think it is now at 200%. When we were in 2007, it was at, was it 110% or 107% or something like that. In 2000, it was at 120%, and in 1929, it was 110% also. Here now, it's at 200%, which means that the stock market is worth the double, of the U.S. economy. So it tells us something about that the US market is simply overvalued, completely overvalued.
Macroeconomist and crypto analyst Henrik Zeberg has issued a dire warning comparing an impending market crash to the devastating 1929 collapse that triggered the Great Depression. Zeberg predicts a severe economic downturn driven by increasing consumer strain, especially in the housing market. He expects this to result in a recession later this year, followed by a deflationary bust and a speculative bubble, even with possible interventions from the Federal Reserve. Zeberg predicts that the next few weeks will remain bullish for the markets, offering substantial returns for investors before the anticipated crash. He highlights that rising interest rates and increasing personal debt payments are putting pressure on consumers, contributing to an economic slowdown. Zeberg points to the housing market as a critical indicator, noting that downturns in this sector often signal an impending recession. Despite possible liquidity injections by the Federal Reserve, Zeberg argues that the natural business cycle cannot be avoided, forecasting a recession by Q4, followed by a deflationary bust and speculative bubble. Zeberg warns that the Fed has been focused on lagging indicators, and it has managed to break the economy beyond repair so much, so that even if it starts cutting today, there will be no stopping the coming 1929-style crash that will shake the markets and have investors running for the hills. We will present clips from Zeberg's recent interview with Jimmy Connor. But before we do, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
So is this the beginning of the end? Yes and no, because if you look at what we have in US, well, then it's not the end, as I see it. If you look at the rest of the world, then yes, this is the beginning of this is actually the top we have seen in some of the indices around the world, as I see it. I think we see that the Nikkei has topped out. I think maybe also we have seen the DAX topping out. There's still, still the jury is still out on that one still, but I think there is a risk that we've seen the top also in the DAX. And also in my own market here, I think we've seen the top there as well, and in Denmark and other places in the world. So, and the UK for that matter also. So I think things are starting to deteriorate really quickly now, and this is not just a US thing. All of it, it's around the world. We have problems all around the world, and something is breaking right now in Japan, which I actually also I kind of predicted this level of the top here, and now we see the deterioration of the declines in the stock market there. So yes, it is there. But if you look at when we look at the U.S. markets, then what happens normally in this kind of a cycle where the economy is actually rather fast starting to deteriorate is that you would have a lot of money starting to circulate or rotate from foreign markets into the U.S. So if you take a look at the Nikkei, you very often would see that the Nikkei tops out 3 to 4 months before we see the top in the S&P, and I think that's what we are at now. And so yes, my target for the S&P still stands. It's 6,100, 6,200 in that area, and that's actually where we're gonna see the strongest move from where we are now. It'll be like from the current levels. I think it's around 15%. And I think we have maybe a few more days of decline, but then I think the U.S. markets are going to really soar into that final top. And again, my timeline of around October. So for the U.S. markets, yes, you can say it's a beginning, because you have the deterioration in the economy that is now coming through, and that the Fed is so hopelessly late on their cutting is just is just adding to the fire. And we have now a hopelessly late Fed compared or combined with with the largest bubble we have ever had, and we have the indicators that that is telling us that recession is coming. So yes, I stand by what I said also, that this is going to be a really bad recession, and we are heading right into it. And at the beginning of this year, it was clear to me that we will get to it by sometime in this year. I thought it would have happened sooner, but that's how it is. And now we start to see, as you said, the beginning of the end. I think there is a pending financial crisis, and I think that we're going to see a very, very big financial crisis also coming to first, I think maybe Japan and elsewhere, but also finally to the U.S. And when these things start to unravel, you will see that, of course, the central banks and especially also the Fed at some point will have to do whatever it takes, and will push and will put give some more stimulus out to make sure that the markets do not decline. But they will, eventually do so. But we will have one more last soar, as I see it.
As a large portion of the market eagerly anticipates the Federal Reserve's next move on monetary policy, Zeberg has pointed out that the central bank is already behind in its efforts to stabilize the situation. He argues that while the Fed will eventually intervene, its actions will be too late to prevent the damage that has already occurred. Zeberg remains confident that a recession will hit by the end of this year, predicting that the market will likely peak in September or October. Despite recognizing that the economy and labor market have been more resilient than expected, he maintains that an eventual downturn is unavoidable. To illustrate the severity of what's coming, Zeberg uses the example of the stock market, noting that the US stock market capitalization is now 200% of the US GDP, more than the 105% bubble we had before the Great Depression in 1929, the 138% of the dot-com bubble, and the 105% of the 2007 bubble that caused the Great Financial Crisis. Plus, this is all without considering the massive crypto bubble and private equity bubble. Zeberg warns that the bubble will burst eventually, and trillions of dollars will be wiped off almost overnight. Let's get back to the interview.
Do you think the Fed is making another policy error right now by not cutting rates?
Oh, 100%. I mean, they should have done that long ago. But the thing is, and again, I think I do not understand why they do not observe that they have always been late, and the reason is that they are following what is in my world a lagging indicator, which means that you see the economy start to roll over, and then the inflation comes. And if you really just go back, you can actually see that's the case. So you have leading indicators that tells you which direction is the coincident indicator going to say which direction is the economy going. And the moment when the leading indicator starts to decline and drop, which they have for 20 some months, 24 months, I think 2 years now, that the Fed still thinks that it's prudent to actually hike rates until just not so long ago. It was a complete error, mistake. So it's not just about this 1 month here. It's we are many months late, and this is what I really cannot understand, because they are actually driving the car forwards and looking out the rear window at this point with the inflation rate, and it's going to come to haunt them. And that, I think, we are going to see a 50 basis point kind of emergency cut here in September, which will be far from enough, because there is also a lag from the moment that they try to do monetary stimulus to they actually get through to the consumer. And at that point, if people have been laid off, and there is a negative feedback loop of that on the market, which we are starting to see, well, then you do not want to spend that money. So it's actually becoming more impotent with the stimulus coming from the Fed or from the cuts, the longer they go into that cycle. And I do not understand why they don't see that, but they are just notoriously late all the time.
So let's talk about oil and copper, because both of these commodities are considered barometers of the global economy. Do you think the pullback in both of these commodities indicates a slowdown in the global economy?
Yes, absolutely. And that's ever since we had the inflation fear, and we had the spike, was it at $120 on oil? I think it was around that level, or was it 130? I can't remember here now, but around that level. And we saw and we started to see oil coming down. That was the moment that you actually started to see the slowing of the economy. It started out slowly, but then it started to do that more aggressively. And the reason why the economy slows is because, first of all, you get inflation hike, so inflation moves up, and that means that people will not be able to, buy as much as they've had, and they were starting to struggle because of that. And then what happens next is that then the interest rates moves up really quickly also, and you have the fastest spike in rates, you've seen for the last 70 years. And of course, people are also getting hit by that. So they have inflation, and now we have interest rates up. What does that create? That creates an economy where the consumer are under pressure. But as we've been stimulating so much, people were sitting with excess cash or with excess savings at that point. But you can now see that that excessive saving is now gone away, and so people are starting to spend less. And you can see if you look at the advanced retail sales, or actually you can see that it's been going sideways for a long time, which is exactly what we see into recessions. So it's not so strange that we see this now. This has been going on for some time because the consumer has not been losing their job yet, but because the companies, the corporations haven't simply been slashing jobs just yet. But that's because they were waiting to see if the demand comes back, and it hasn't. And now we start to see the unraveling of things. And yes, the economy is slowing and has been doing that for a long time. And I think oil is going to come down. My target is around $10 at the bottom of the recession. And I think that's going to be next year at some point.
Zeberg expects the ongoing market recovery to go on for a few more weeks until we hit a peak in October. Then the recession will hit and the everything bubble burst will begin. Here is a recent social media post from the popular Economist. As we, in the coming few months, reach all-time highs in US stock market and in crypto, the current bearish sentiment will develop into strong bullish sentiment and euphoria, and the markets will soar. I will be told that I'm wrong about my forecast of a coming top in US markets, but a recession is coming and the largest bear market since 1929 will begin. Do you agree with Zeberg's warnings about an inevitable recession for the US and global economy? Please share your thoughts with us in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. Thanks for watching our videos.